So how would you like to retire 20 years from today? Starting with $0 with ever increasing income year after year. Oh, and by the way, how about tax-free as well? All right, you guys know how much I'm about the data and the spreadsheets and the analysis, so let's dive in. We're looking at the S&P 500 ETF, SPY. To accomplish this feat, we're going to own and continually buy shares of SPY, the S&P 500 ETF. Very simple and straightforward investment, the broad market. We're looking specifically at historical data for the S&P 500 dating back to June of 2003, going all the way down here to May 31st of 2023. We're going to track shares accumulated. We're going to contribute money. I'll get to that in a second. We're going to sell weekly covered calls on SPY. And remember at the beginning I said tax-free, because we're going to do all of this within the confines of a Roth IRA. For those of you that are not aware, with a Roth IRA retirement account, you don't get any tax benefit when you contribute money to the account. However, all of the money inside of the Roth IRA grows tax-free. So when you decide to take money out, no matter what type of income it is, whether it's call option premium from covered calls, whether it's dividends, whether it's the original money you deposited, whether it's growth in the capital of the retirement account, doesn't matter. It's all tax-free. And again, all of the option data is right in here. Selling weekly covered calls, what the strike price is, what the option premium is, how many contracts we're selling based on how many shares we own. And then I do my very best to assume what those strike prices are and the option premium earned based on historical data, but also based on the actual current option chain for SPY, which is right here. I'll admit it's not a perfect way to assume what option premium was in the past, and there's no great way to actually get that historical data, but I think it does a reasonable job of giving you an idea of what type of option premium you could have earned in the past and just how much that impacts how much cash flow you have in the future. We're gonna look at contributions to the account, and what I did specifically in this analysis is I looked at what were the historical Roth IRA limits dating back to 2003, going all the way to 2023. And then I built into the spreadsheet, depending on what year in the analysis we were in, we made sure that we are maxing out our Roth IRA. So going back to 2003, the maximum we could have deposited was $3,000 annually. So if you look at the spreadsheet, 250, 250, 250 every single month. However, we can, if you look forward here to a couple years in, now we're at 416.67. And I recognize that the average Joe may or may not, depending on where you live in the United States, depending on your unique circumstances, you may not be able to contribute $400 or $500 a month. But then again, this analysis does not assume you're doing that from the outset. We're starting at $250 a month, but eventually we're building up to that amount in years 9, 10, 15, and 20. And again, based on the final results, you may find that, hey, I don't need that much money in order to retire, and that's great news. We're also trying to truncate this analysis down to 20 years, right? It's pretty cool if you can start with $0 and still retire with ever increasing income year after year, tax-free. And then based on all of this data, we're gonna look at 3 different scenarios. Number one, what would it look like if we didn't sell any covered calls, we just invested into the S&P 500 month after month, year after year? What would our portfolio balance be, total cash flow, and most importantly, when we're ready to retire, what is our cash flow in year 20? But then we'll look at a scenario when we are also selling covered calls based on how many shares that we own. These are weekly covered calls out of the money based on a 20 delta. What this means is essentially is you're capturing both option premium, but that strike price is above the current market price week after week, meaning that you are also capturing a portion of that capital appreciation in the stock price growth as well. And then just as an additional analysis, I wanted to see, well, what if we just were able to start? What if we had a lump sum of money available to where we could start with 100 shares, meaning we would have the ability to start selling covered calls on day one, which we do not have the ability to do if we're starting from $0. We'll look at the differences between those 3 different scenarios, between portfolio balance, cash flow, and year 20 income. And I think you're gonna really like the results. So let's dive in. So let's go back over here to our analysis. So no covered calls right here. What does our portfolio balance look like? After 20 years, our portfolio balance is $180,526.98. And of that $180,000, $101,000 of it was contributions. And this really reflects the fact that, especially at the end of the analysis, we were contributing quite a bit of money month after month here, right around $541 in the last year. The total cash flow, which would only include dividends, considering we're not selling options here, total cash flow over the entire period, which was all reinvested back into SPY, $34,210.21.
And most importantly, if we're trying to retire and live off of the cash flow, that's the goal, hopefully, year 20, only $4,587.98. So in reality, if we're trying to do this in 20 years and we're trying to live off the cash flow, not really an option. If we really had to live off this income in year 20, we'd have to start selling shares in order to generate enough capital to live on, and that's not going to be sustainable for the long term. But what if we sold covered calls on a weekly basis, very straightforward, out of the money, and reinvest all that option premium and reinvest all dividends? Well, in that scenario, we'd have $421,485.17. For those options enthusiasts out there, I did account for the scenarios throughout this 20-year period where the stock price might have zoomed past our strike price and we might have had a situation where our shares were assigned and we had to buy back into the stock, but the stock price was higher. And the way the analysis is built is, in that scenario, we buy only as many shares as possible based on the current market price, which could result in a reduction in the shares owned. So you might have gone from, let's say, 300 shares down to 260 shares if the stock price had rallied quite a bit. So all of those realities of selling covered calls, that's built into this analysis. Okay, so balance, $421,045.17. Total cash flow over the entire period, $255,763.33. And the majority of that here is likely going to be option premium, though you are going to see more dividend income as a result as well, since we own more shares. Most importantly, year 20 income. How much money can we generate from this portfolio without selling shares? Can we live on that amount? I think so. $46,835.04. And again, let me remind you, this is all tax-free. Yes, we didn't get a deduction in the beginning, but all this money we're pulling out of the account, whether it's $30,000, $50,000, it's all tax-free. Now, what if we had the ability here to start with 100 shares? Because if you'll notice, if we look at this analysis, remember we started with $0 here, so we didn't have 100 shares, which means we can't sell covered calls unless we have at least 100 shares. We were not even able to start selling covered calls until, I believe, let's see here, 2003, 2004, let's keep going down. Here we go. Our first covered call was sold right here in September of 2006. So over 2 years of just building shares. What if we were able to start on day one by selling covered calls? Well, in that scenario, our portfolio balance would be $563,614.32. Total cumulative cash flow earned between option income as well as dividends would be $350,809.26. And year 20 income, the amount of income we could generate in year 20, $61,435.67. This should be exciting and motivating for you guys, especially if you have $0 saved right now. The best thing I could tell you to do is literally go out today, like right now, go and open up a Roth IRA and start making contributions. If you can, max out your contributions for this year. If you can't, just contribute as much as you can. All right, let's take a look at some of the analysis in the graphs here. Here's a look at the price history for SPY over those 20 years. You'll notice there was really normal growth right here. And then we hit the housing crisis. We dropped down pretty significantly. And then we grew for, I don't know, 10 years. Then we had the COVID drop right here, a massive growth here from after the COVID drop. We had a little bit of a drop here in 2022. Here's a look at our share accumulation over time. Assuming we were selling covered calls, here's how we started with 0 shares, and over time, by selling covered calls eventually, we didn't start selling covered calls till right around here, and there's a slight bend upward here. Then we have some drops here, these little blips where we drop down, drop down, drop down, drop down here in 2011. These are all situations here along the way where the stock price zoomed past our covered call strike price and we had to end up selling our shares for an amount less than the current market price. As a reminder, that does not mean you're losing money. It's more of an opportunity risk, and we can explain that more in my next video, which is all about everything you need to know for the beginner covered call investor. These do not fundamentally change where we end up. They're just small blips along the way. You see them here again as well along the way. A big one here happened in COVID, which I think is reasonable. We had a big share drop right here, and this occurred right here, right when there was a big rally and we had a lot fewer shares as a result. But despite that, we still had quite a bit of cash flow, and we'll look at that in just a second. All right, here's the portfolio balance overlaid by the stock price change from 2003 to 2023. Blue is the portfolio balance, and then orange is the stock price for SPY. And they've pretty much moved together here simultaneously starting in 2015, though the balance is so small here for the first couple of years that you don't see the real big changes. This is my favorite graph of all of them. Annual income year over year from year 1 all the way to year 20.
Look at this income here. Year one was just atrocious, right? $23.31 just from dividends earned on a very small balance. Then we go to $94.82 and then $164. And at this point you're thinking, what is the point of all this? We're not earning any income at all. But then year 3 to year 4 is when we start to sell covered calls, and that's when we start to generate more income. And then from there, it just continues to grow. We had a drop here from year 5 to year 6 as a result of some of our covered calls going in the money and having to buy fewer shares. So we had a small reduction here. And then from there, we grew quite a bit year after year. And I think it's right around maybe here, year 9 or 10, when we start to feel as an investor, this is amazing, this is exciting, I can't wait for this to grow to something really big. And then as you see it here, year after year, along the way here, at any point, if you absolutely needed cash flow, you could start taking contributions out because, again, let me remind you, one of the great features of a Roth IRA is you can take out some of the contributions tax-free at any time. The money you put in, you can take out with no consequence, no tax penalties, nothing. So if you needed to tap into some cash here along the way, you didn't need to wait until we were at $46,000. You could have done it here at 42 or 31 or 28. You might find yourself in a situation where you only need $24,000 to $30,000 a year in tax-free income, in which case you can do this in 16 or 17 years. Hopefully, again, this gets you really excited about what the potential is by selling a very straightforward set it and forget it covered calls week after week. This doesn't account for real life where you can actually potentially roll your options or adjust your strike prices along the way to capture more capital appreciation along the way. If there's other stocks or investments you want to see this analysis with, make sure to leave your comments down below. We can certainly look at different iterations of this. We can look at more conservative strike prices, different investments, different time frames if you want to. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to every comment that is left on the day I post a new video. Also remember, this coming Friday, the very next video we do, we're going to do a breakdown, everything you need to know for the average Joe investor who's looking to start selling covered calls. That's all I got for you guys in this video. Have a great rest of your day, and thanks for watching.